Welcome to the deep dive. Today we're going back, taking you back to a year that really fundamentally reshaped financial thinking for, well, an entire generation. 2008.
hmm
If you were around then, you probably remember the feeling, right? The widespread fear, those dramatic headlines, just the sheer uncertainty everywhere.
Oh, absolutely. Felt like the ground was shifting.
Exactly. But what if we told you that for some of the really savvy investors, it wasn't just seen as a crisis, but maybe, just maybe, the opportunity of a lifetime?
That's precisely the angle we're exploring today.
Yeah.
Our deep dive is into this really powerful document. The annual letter François Rochon wrote to his partners at Giverny Capital right at the end of 2008.
Okay.
And this isn't, just some dry financial report. It's more like a masterclass.
Yeah.
A masterclass in how to look at market downturns, how to understand the, well, often irrational psychology of investing.
Right.
And crucially, how to stick to those enduring principles of value when pretty much everyone else is hitting the panic button.
So our mission today really is to pull out the most important nuggets of knowledge, the key insights from this letter. And you'll see pretty quickly why, even all these years later, its lessons are just incredibly relevant for navigating, well, any market, up, down,
Yes.
sideways.
Yeah, the principles hold.
So let's get into it. This opportunity of a generation.
Right. So François Rochon opened his 2008 letter, calling it, maybe with a bit of understatement, a difficult year for the stock market.
Yeah, difficult might be putting it mildly.
Just a bit. We saw world markets plummet by over 50%. And what's really striking, I think, is that even economies people thought were sort of decoupled from the U.S.,
Like China or Brazil.
exactly, China, Brazil, Russia, India, they saw staggering drops too, 50 to 75%. This wasn't just, a U.S. problem. It was a global earthquake.
And the damage was just everywhere, hitting the biggest names. Bear Stearns, Lehman Brothers, Merrill Lynch. I mean, these were institutions that literally vanished or got swallowed up overnight almost.
Mm-hmm.
And giants like AIG, Freddie Mac, Fannie
Yeah.
Mae, they just collapsed, needed huge government intervention. The level of pessimism, that sense of dread in the air, it was off the charts.
It really felt like the financial world might actually be ending for a bit there.
It did.
But, in that chaos, Giverny Capital identified what they saw as these, well, unprecedented signs of potential high returns in the future, a real generational opportunity.
Okay, so what were these signs? What were they actually looking at?
Well, consider these indicators. The S&P 500's price-earnings ratio, that's basically the price you pay for each dollar of a company's, let's say, normalized profit.
Right, sort of the adjusted, more stable earnings picture.
Exactly. That ratio is around 9 times.
9 times. Okay, for listeners who maybe don't track this stuff daily, what does a PE of 9 actually mean in that kind of environment? Was it just a blip or?
It pointed to extreme undervaluation. I
Wow.
mean, 9 times earnings was a level we hadn't seen since 1979. It basically screamed that stocks were incredibly cheap relative to the actual earnings power of the businesses. And you combine that with U.S. consumer confidence hitting an all-time low, 25. The previous low was 42 back in 74. People were just utterly terrified.
Rock bottom, emotionally speaking. And didn't you mention cash on the sideline?
Yes, that's the other piece. There was an estimated $7 trillion in cash just sitting there in the U.S. economy.
Mm-hmm.
Enough, theoretically, to buy every single company in the S&P 500 at that point.
7 trillion. So what does that tell us? Just sheer fear.
Profound investor fear. Money wasn't moving. Plus, you had interest rates on treasury bills at practically zero. So those safe bonds, they looked incredibly unattractive, especially when you factor in inflation.
Right.
And most investors, we're talking big institutions too, were extremely pessimistic. They held very low amounts of stocks. So you put it all together, extreme undervaluation,
Yeah.
unattractive alternatives like bonds, tons of cash waiting, and just widespread fear.
It's like the perfect contrarian setup.
Exactly. The classic blood in the streets scenario that, legendary investors like Warren Buffett talk about.
And speaking of Buffett, he actually spoke out pretty loudly then, didn't he? Urging people to buy.
He did, famously urged investors to buy equities for the first time since, 1979. And he gave that timeless advice. Be fearful when others are greedy, and be greedy when others are fearful.
Mm-hmm.
And he added, very directly, fear is now widespread.
That's a huge endorsement, especially from Buffett, who, doesn't make those calls lightly.
Absolutely. So it's one thing to talk about value investing. It's another to actually do it when everything seems to be falling apart. How did Giverny Capital actually do by sticking to their guns in 2008?
Well, the results speak for themselves, really. In 2008, their portfolio returned negative 5.5%.
Okay, still negative, but in context.
Right, context is everything.
Right,
Their
right.
weighted benchmark index was down roughly negative 22.0%. So Giverny added value of plus 16.5%.
Wow, okay, that is seriously impressive outperformance in just a brutal, brutal year for almost everyone.
It really is. And their long-term track record, well, it underscores this philosophy. Since July 1993, their annual compounded return is 14.0%. 14% annually, compared to...
Compared to 6.4% for their comparative index group. So that kind of consistency over decades, it isn't luck.
Definitely not.
And, their confidence in their approach, it even showed up in the artwork they chose for the letter's cover that year, a painting by Dill Hildebrand called Dusk.
Dusk. What was the symbolism there?
They felt it represented their belief that the bear market was, nearing its end, that the lights of the next bull market were sort of flickering on the horizon. It's like an artistic way of saying, we see the turn coming.
I like that. So what actually anchors them through times like that? What are Giverny's core guiding principles?
It's crystal clear, really. They focus on solid companies, companies with great balance sheets, good profit margins, and this is critical, honest, and accountable people at the helm.
So fundamentals and management quality.
Exactly. It's about the business itself. And their prudent approach to stock pricing, not overpaying, that proved to be a massive benefit in that bear market.
Makes sense. Pay less, less far to fall.
Precisely. And this brings up a really important point they emphasize. How do they define a stock? For them, it's not just a ticker symbol flashing on a screen.
Right?
It's ownership of an actual business. So they focus intensely on what they call owner's earnings.
Owner's earnings. Explain that a bit more. Is it different from standard reported profit?
Yeah, it's essentially the cash profit a business generates that's truly available to its owners after you account for all necessary expenses and, crucially, the capital needed to maintain the business. It's a more realistic measure of profitability.
Got it.
And here's what's fascinating. In 2008, across Giverny's portfolio, these owners' earnings only decreased by about 3%.
Only 3% in 2008.
Only 3%. Meanwhile, the S&P 500's overall operating earnings, a more standard measure, dropped by a staggering 30%.
Wow. Okay, that's a massive difference. It really shows the resilience of the actual businesses they owned, even if the stock prices were getting hammered.
Absolutely. It highlights that huge distinction between market sentiment, which was panicked, and the underlying business fundamentals, which for their holdings were much stronger. Helps explain that outperformance we talked about.
Definitely. So if that's how Giverny navigated the storm, what about the traps? What did Rochon warn investors against doing, even in a crisis like '08? He mentions something called the flavor of the day.
Yes, the flavor of the day. It's a great term, isn't it?
It is. Captures it perfectly.
It's that asset class or sector that the market just gets irrationally excited about. Everyone piles in, right? Giverny believes you have to actively avoid that stuff.
Like tech stocks back in 99, 2000,
Oh,
or
right.
commodities more recently, like in 2006 to 2008.
Exactly, those kinds of things. So the interesting question is, what did Giverny see as the most dangerous flavor of the day? The riskiest investment, ironically, in 2008?
Okay, I'm intrigued. What was it?
Treasury bills.
Wait, T-bills. The thing everyone considers the safest possible investment. That was the riskiest.
Ironically, yes. According to Giverny. It sounds completely counterintuitive, I know.
It really does. Okay, break this down. You mentioned the $7 trillion in cash. T-bill rates near zero, like 0.07%. 10-year bonds at 2.2%, 30 years at 2.7%. Why on earth were these considered the riskiest?
Because Giverny warned of, and this is their term, guaranteed impoverishment.
Guaranteed impoverishment.
Think about it like this. You hold a bond paying, let's say, 2% interest. But inflation, the rate prices are going up, is running at 3%, which was the historical average, and they projected maybe 4% going forward because of all the money being pumped into the system.
Right. So your money's buying less each year.
Exactly. Your money's actually losing purchasing power. You're getting a real return of negative 1.5% every single year. That 2% yield doesn't even cover inflation.
Ouch.
Over a decade, it really adds up. It could be a total loss of purchasing power of maybe 14%, even before you pay taxes.
Yeah.
And for longer bonds, like 30-year ones held in a taxable account, they calculated you could lose up to 45% of your real wealth.
45% lost by playing it safe.
Guaranteed impoverishment. It's like putting your money in a savings account that just quietly shrinks every year. You feel safe, but you're losing ground.
That's a really powerful way to reframe safety in investing. It's not just about not losing nominal dollars. It's about preserving purchasing power
Yeah,
and
there's
opportunity
stocks.
cost.
What else could that money be doing?
Precisely. So how did Giverny translate these principles into action? What kinds of, bargains did they find amidst all that chaos? Let's look at some of their actual holdings.
Yeah, let's get specific.
Well, they definitely took advantage of the panic. Take Notorico. It's a Japanese household retailer. In 2008, their earnings actually went up 13%, and the stock rose 30%.
Wow.
In Japan,
You had this everyday low price strategy that resonated, plus the yen was strong, which helped. Then you had Walmart, sort of a classic defensive stock. Their profits were up 6%, same-store sales up 3%. Pretty remarkable in that retail environment.
and they made some smart moves too, right? Like slowing store openings.
Very smart. They reduced new store openings and used the cash to buy back their own shares. Shrewd capital allocation.
Okay. What else stood out?
Bank of the Ozarks in the U.S. This was a real standout during a banking crisis. Assets up 19%, earnings up 9%.
Bank growing in 2008.
Yeah. The CEO, George Gleason, he'd built this incredibly conservative culture since buying the bank for basically nothing when he was 25. It just shows how much difference strong conservative leadership can make, especially in finance.
Absolutely.
Night transportation, too. Trucking was getting hammered, right? But their revenues were up 8%, and earnings per share, EPS, was only down 9%. They maintained this exceptional efficiency ratio. Giverny called them an oasis in the desert.
Finding strength even in struggling sectors, that's key.
Exactly. They also saw huge long-term potential in companies that maybe looked beaten up short-term. Wells Fargo, for instance.
Right, another bank.
Yeah, but they made this bold move acquiring Wachovia. Basically doubled their assets, got it at a good price during the chaos. Giverny saw the potential for their earnings to eventually double, maybe pushing the stock towards $60.
Thinking long-term past the crisis.
Always. Disney, they called it a best company, brilliantly managed.
Yeah.
In 2008, it was trading at 10 times earnings.
10 times for Disney, that seems low.
Incredibly low. A level not seen since the mid-1960s, even though the core business was still fundamentally strong. American Express, too, solid brand, right? Had a tough 2008, EPS down 28%. But Giverny expected it to rebound significantly in the next cycle. They thought it could potentially reach $65, which was more than 4 times its low point in 2008.
Wow. Big potential upside.
Then you have O'Reilly Automotive. Auto parts. They grew massively from 1,200 stores to 3,200, partly by acquiring CSK Auto. Smart move in a recession, people fix old cars instead of buying new ones.
Good point.
Fastenal. Giverny called them dull, but making a decent buck.
Ah, love that description.
Yeah.
Industrial supplies, right?
Yeah, fasteners, tools, that kind of stuff. But look at the record. EPS up 450% over 10 years. That's 18% annualized growth. And they saw potential for it to double sales and profits again. Boring can be beautiful in investing.
It often is.
CarMax, the used car retailer, biggest in the U.S., but even then, they only had like 2% market share. Huge fragmented market. Giverny projected maybe 15–20% annual growth for the next decade.
Lots of room to run.
And even Mohawk Industries, the flooring giant. Tough year, obviously, with housing collapsing, but seen as deeply undervalued, with potential to hit $120 a share if profitability just returned to normal levels.
So they were finding value across different sectors. Were they making new buys too?
Oh yeah, actively buying. One example was Martin Marietta Materials, leading U.S. producer of aggregates.
Aggregates, so like crushed stone, gravel.
Exactly. The essential stuff for roads, bridges, buildings. They bought it because it has strong competitive advantages, hard to replicate quarries and long-life reserves. Plus, about half its revenue came from infrastructure projects, which seem poised for a rebound with potential government spending.
Smart counter-cyclical thinking there.
And Omnicom, the advertising giant. Another interesting buy. Ad spending gets hit in recessions, right? But Omnicom had shown resilience. Its EPS was way up from 2002. And in 2008, it was trading at just 8 times earnings.
8 times. For a leader like Omnicom, what was its usual multiple?
Historically, more like 22 times earnings. So it was trading at maybe a third of its intrinsic value, its true underlying worth. Plus, they were strategically buying back their own shares, which Giverny liked to see.
Okay, so lots of opportunities, but not everything works out perfectly, right? Did they talk about challenges?
Oh, absolutely.
Yeah.
Transparency is key for them. Allied Irish Bank, AIB, was a particularly tough one. The Irish economy was in turmoil. Another Irish bank got nationalized. Huge fears about dilution for AIB shareholders.
Yeah, that sounds scary.
The stock dropped massively. But Giverny, after reviewing it, decided to hold. That must have been a difficult call.
I bet. Any others they reconsidered?
Walgreens, the pharmacy chain,
Yeah.
usually seen as defensive, right?
Mm-hmm. Steady Eddie.
Well, Giverny felt its long-term growth fundamentals weren't quite as strong as they used to be. Growth seemed to be slowing from maybe 16–17% historically down to a projected 7–10%. So even for a solid company, if the growth story changes significantly, they'll reconsider the investment case.
That makes sense. It's not just about quality, but also future growth prospects relative to price.
Exactly. Which leads us to another really insightful and, frankly, refreshing part of their letters, the practice of doing postmortems on past decisions. They even highlight their mistakes du jour.
Mistakes du jour. I love that. It's so rare to see that level of transparency and self-critique. It's how you learn, right?
It really is. It's powerful. So looking back at their 2003 investments, for example, they still held some winners like FactSet Research, Expeditors International, ResMed. Yeah. Good calls there.
Okay.
But they also discussed selling Harley-Davidson. They'd become concerned about its finance division, basically the part making loans for the bike.
With the lending risk.
Right. And that decision proved right years later, even though the Harley brand itself was still incredibly strong. They also called Fifth Third Bank a clear, poor investment. They sold, but maybe not soon enough after their conviction changed. Seeing it drop from $40 down to $2, that's a stark reminder about cutting losses when the thesis breaks.
Oof. Yeah. Okay. So what were the official mistakes du jour for the 2008 letter? The bronze medal.
Bronze went to selling First Cash Financial. It's a pawn shop operator. Giverny sold shares because they disagreed with management's initial refusal to sell off a losing car division.
So a governance issue, basically. Confidence in leadership.
Exactly. Now, management did eventually reverse course, sold the division, and the stock did well afterwards, but Giverny stood by their decision to sell based on that initial disagreement about strategy and leadership judgment. It underscores how important management trust is for them.
Interesting. Okay, silver medal mistake.
Ritchie Brothers Auctioneers. This was a big missed opportunity. It's kind of a dull business. They auctioned used heavy industrial equipment.
Right. Not exactly glamorous.
Not at all. Giverny initially looked at it but thought the PE ratio, the price to earnings, was maybe a bit too high. They worried about it being cyclical, tied to the economy.
Understandable concerns, maybe.
Maybe. But the company thrived. Its sales and earnings tripled over the next 10 years, and the stock quadrupled. It was a lesson, perhaps, in overlooking a simple, effective business model because it didn't seem exciting, or maybe being too worried about valuation.
Wow. Tripled and quadrupled. Okay, that's a miss. So the gold medal. The biggest mistake.
MasterCard.
Ooh, MasterCard. Why was that the big one?
This one clearly stung because they knew the company well. They acknowledged its pretty good economic model. It's basically a toll road for electronic payments, right? Processing transactions.
Yeah, fantastic business model.
Fantastic. But they chose to stick with American Express instead, which they also owned. They seemed to overlook MasterCard's potential for massive margin expansion, getting more profitable on each dollar of revenue. And crucially, MasterCard didn't have the credit risk, the bad loan problems that ended up hurting Amex during the crisis.
Ah, so MasterCard was just the processor. Amex was both processor and lender.
Exactly. And the results were just stunning. MasterCard's earnings per share surged 4.5 times in just 3 years. The stock was up 200% while Amex was struggling.
Ouch. That is a tough one to miss, especially when you understood the business model.
It really illustrates how easy it is to miss a huge winner, even when it's right under your nose, maybe because a seemingly similar competitor feels safer or just more familiar.
Yeah. Wow. Okay, so wrapping things up, François Rochon brought it back to Warren Buffett, didn't he?
He did, pointing out that Buffett, arguably the best investor ever, had only really enthusiastically recommended investing a few times before 2008, notably back in 1974. And 1979.
1979. Wasn't that when Businessweek had that infamous cover, The Death of Equities?
That's the one. Talk about peak pessimism. The death of equities.
Yeah. Pretty definitive statement.
Yet, at almost the exact same time that magazine cover came out, Buffett published an article arguing the opposite, saying that pessimism was the friend of the true long-term investor.
And what happened next?
The decade that followed saw a 400% total return for the market, about 17% annually. History really does rhyme, sometimes with beautiful irony.
Absolutely. It just brings you back to that constant cycle in financial markets, doesn't it?
Exactly. They're created by humans, so they're prone to these huge swings, massive optimism, then deep pessimism. Giverny explains that there's this trap just waiting for investors who can't remain impervious, who get swept up in the emotions.
And the trap is selling low, right?
That's the ultimate trap. As Giverny puts it, the only way to truly lose money in the long run with good businesses is to sell during corrections. locking in those temporary losses.
Such a powerful, almost philosophical point about investing.
It is. And Giverny Capital basically reaffirmed their commitment to avoiding those emotional decisions during crises, focusing on being rational stewards of their partner's capital, rewarding that confidence.
Being rational when everyone else is emotional. That seems to be the core message.
It really is.
So to kind of bring this all together then, the 2008 crisis, as devastating as it felt at the time, was actually viewed by disciplined, seasoned investors like Giverny Capital, like Warren Buffett, as this rare, maybe once-in-a-generation opportunity.
The enduring lesson here, I think, is the sheer power of a long-term, value-oriented approach.
Yeah.
Focusing on the real intrinsic value of the businesses you own, not getting lost in the short-term market noise.
Right.
And maybe most importantly, recognizing that widespread fear, that panic, often presents the greatest opportunities, but only if you can think clearly when everyone else is losing their heads.
So it leaves us with a thought, doesn't it? Consider this. If the flavor of the day is so often a trap, what perceived safe haven or maybe sure thing in today's market might actually be setting investors up for the next kind of guaranteed impoverishment.
That's the question.
What does this deep dive into 2008 inspire you, our listener, to maybe reevaluate in your own approach to all the information noise out there and your own investment decisions? Something to think about.